The most unsettling truth in finance is that people often believe something is safe simply because everyone else believes the same thing. That collective belief can build an entire market, inflate an entire industry, and create the illusion of stability where none exists. Bitcoin has become the perfect example of how confidence, not intrinsic value, can carry an asset further than logic ever intended. And when confidence is the only real foundation, a collapse doesn't begin slowly. It happens all at once. Today, I want to walk you through the uncomfortable reality behind the world's most hyped digital asset, because understanding what you hold, or what you think you hold, is the only protection you have when risk masks itself as opportunity. People often ask why anyone would suggest that Bitcoin could go to zero when it has already grown to unimaginable heights. But price does not prove value. It merely measures enthusiasm. The truth becomes visible when enthusiasm disappears. Bitcoin is a digital token without a claim on earnings, assets, or productivity. It doesn't own land, generate cash flow, or produce anything of lasting utility. It exists because people agree it exists, and it keeps rising because more people agree tomorrow than yesterday. But confidence is fragile, and history shows that whenever an asset is driven by crowd psychology rather than real economic output, its fall is inevitable and swift. Let's talk about psychology for a moment, because every bubble in history has been fueled by the same emotional cocktail: fear of missing out, excitement over quick returns, and the belief that the rules of financial gravity have somehow changed. Bitcoin investors often say they're early to a revolution, but revolutions don't need to be traded at 24 hours a day to hold value. They produce measurable progress in real-world systems. Bitcoin, despite its popularity, has yet to establish itself as a reliable unit of exchange. It fluctuates too wildly to be currency and offers too little intrinsic value to behave like a traditional investment. When people buy it, they're not buying underlying value. They're buying the hope that someone else will pay more later. The distinction between a real asset and a speculative product matters more now than ever. A real asset gives you something: ownership of a business, dividends, land, equipment, innovation, utility. You may endure volatility, but the underlying value is still there. Bitcoin offers none of these things. It provides no interest, no ownership, no output, and no claim on future earnings. It is simply a digital code supported by collective enthusiasm. If that enthusiasm falters, what remains? Unlike a company, a farm, or a piece of property, there is nothing left to hold. And assets without substance do not gracefully decline when fear enters the market. They crumble because there's nothing underneath them to slow the fall. Confidence can vanish much faster than it builds. For traditional investments, even in moments of widespread fear, there are tangible reasons why value does not disappear overnight. There are factories still operating, management teams still working, products still selling. But Bitcoin is not anchored to economic activity. It's anchored to sentiment alone. When sentiment shifts, and it always does, there is no floor. The price people are willing to pay can drop from thousands to nothing, because nothing fundamental is left to support it. The digital financial world has never endured a moment of global panic with Bitcoin at its center. But if that day comes, the outcome could be far more violent than any collapse we've previously witnessed. For anyone thinking about long-term security, the priority should not be chasing quick profits. It should be avoiding irreversible losses. The most dangerous investments are those that appear strong but are hollow underneath, and Bitcoin sits at the top of that list. Protecting yourself in a speculative environment means focusing on assets rooted in productivity, cash flow, and real-world utility. It means accepting that hype can create temporary wealth but cannot preserve it. And it means remembering that in investing, the easiest money you'll ever make is the money you don't lose by avoiding a collapse that everyone else insists will never happen. The foundation of Bitcoin is often described as revolutionary, unbreakable, and destined to reshape the global financial system. But when you look closely at what actually supports its value, you find far less substance than the public narrative suggests. Markets have always been influenced by belief, but belief alone has never been enough to sustain something indefinitely. especially when the underlying structure lacks the components that make assets resilient in moments of stress or uncertainty. People assume Bitcoin's strength comes from technology, decentralization, or scarcity. But strength in investing has never come merely from what people believe an asset represents. True strength comes from what an asset produces, what it earns, and how it contributes to real economic activity. Without that, you're left with something held up entirely by sentiment, and sentiment is the most unpredictable foundation you can rely on. The first sign of a weak foundation is that Bitcoin's entire value system depends on the idea that people will continue to demand it at higher and higher prices. Unlike a business that generates revenue or property that provides shelter or rental income, Bitcoin provides no utility outside the belief that it holds value. The moment belief wavers, there's nothing else to fall back on. A company with falling stock prices still has customers, factories, employees, and products. A farm still grows crops even if markets turn bearish. But a digital token with no economic engine behind it becomes nothing more than a number on a screen when confidence disappears. And numbers on a screen can vanish much quicker than physical or productive assets. Even the idea of scarcity, which so many supporters hold up as Bitcoin's greatest strength, can be misleading when scarcity is not connected to intrinsic usefulness. Gold is scarce, but it also has real utility in electronics, medicine, and manufacturing. Farmland is scarce and will always be necessary because people need food. Bitcoin is scarce by design, but scarcity without function becomes more of a speculative feature than a protective one. Just because something is limited in supply does not guarantee it will always be desirable. History is filled with objects that were scarce, valued for a time, and later discarded because they no longer held relevance. Scarcity only creates lasting value when the object itself performs a role that society will always need. People often point to blockchain technology as a reason Bitcoin will maintain worth, but blockchain itself is not Bitcoin's exclusive property. It's a technology that can exist independently of the currency attached to it. Many institutions have already developed their own blockchain systems that operate more reliably, more efficiently, and with more oversight than Bitcoin's open network. If the underlying technology can be separated from the asset, then the asset's value cannot rely solely on the technology. What matters is not the existence of the blockchain. It's whether the token tied to it creates real economic value. And in Bitcoin's case, the answer remains uncertain at best. Another foundational weakness lies in Bitcoin's inability to serve consistently as a medium of exchange. For something to function as currency, it must hold predictable value, move easily between parties, and be widely trusted for everyday transactions. Bitcoin's volatility makes it unreliable for pricing goods or services. Its transaction network becomes congested during periods of high activity, and many merchants avoid it because they cannot risk accepting payment that might fluctuate dramatically within minutes. When a currency can double or collapse within a short period, it behaves less like money and more like a trading instrument. Money is supposed to be stable. Bitcoin, in its current form, is anything but stable, and that instability prevents it from fulfilling the very role that many claim it will eventually dominate. Adding to this instability is the fact that Bitcoin's worth is highly sensitive to news, speculation, and emotional reactions from the market. A single announcement from a regulator, a major exchange outage, or a shift in government policy can cause massive price swings. Markets that rely on external confidence rather than internal value are always vulnerable to rapid collapses because they behave like crowds. One person panics and others follow. Without intrinsic value to anchor it, Bitcoin's price can swing more violently than traditional assets, and when a market swings violently, it exposes the fragility of its foundation. The stronger an asset's intrinsic value, the less vulnerable it is to emotional selling, and Bitcoin has no such protection. Another sign of weakness becomes visible when you examine how heavily Bitcoin relies on new participants entering the market. A healthy investment ecosystem can sustain itself on performance and productivity. Bitcoin requires constant inflow from new buyers because there is no underlying cash flow or business model to generate organic return. The only way existing investors profit is if new investors come in at higher prices. That dynamic alone forces you to question the durability of its foundation, because systems that rely on continuous new participation to maintain existing value are always at risk when enthusiasm fades. Markets do not stay enthusiastic forever. They never have, and they never will. There's also the matter of trust. Bitcoin was designed to eliminate the need for trust in centralized institutions, but in reality, the average person does not understand how the system works well enough to navigate it independently. They rely on exchanges, platforms, influencers, and custodial services, many of which have already collapsed or engaged in fraud. When a system meant to remove trust ends up requiring even more trust in new intermediaries, the foundation becomes even more questionable. The irony is that the structure built to overcome traditional financial risks has introduced a new set of risks that many investors don't fully comprehend. Energy consumption introduces another layer of fragility. Bitcoin mining requires enormous computational power, and the cost of sustaining that power grows as the network expands. When profitability depends on price staying high enough to justify mining expenses, the system becomes sensitive to downturns. Miners cannot operate at a loss indefinitely, and if fewer miners participate, the security of the network weakens. A financial asset should not be vulnerable to changes in electricity costs or shifts in hardware efficiency. But Bitcoin's network is deeply intertwined with those factors, adding yet another instability to its foundation. Then there are regulatory risks. Governments around the world are still unsure how to classify, control, or integrate cryptocurrencies into existing systems. Bitcoin's future depends on decisions made by institutions that have not yet settled on a unified stance. Some countries will embrace digital assets, while others will restrict or ban them. This uncertainty creates an unstable environment where long-term security is difficult to guarantee. If the foundation of an asset includes unpredictable legal and regulatory conditions, then it is not a stable foundation at all. The final layer of weakness comes from the disconnect between Bitcoin's narrative and its real-world adoption. Supporters often speak about a future where Bitcoin becomes the dominant global currency, but the actual use of Bitcoin in everyday commerce remains minimal. Most people holding it are not using it. They are waiting for it to rise. When an asset's primary purpose becomes speculation rather than utility, it moves further away from stable value and closer to the kind of fragility that leads to sudden collapses. The gap between narrative and reality widens each year, and gaps like that eventually close, usually not in the direction investors hope. The psychological traps that pull investors into assets like Bitcoin are far more powerful than most people realize, because they operate quietly beneath the surface, shaping decisions long before the investor understands what is happening. Human behavior has always played a decisive role in financial markets, but digital assets amplify those tendencies to a level that makes rational judgment exceptionally difficult. The first of these traps is the fear of missing out, a sensation that spreads faster than any financial warning ever could. When people see others getting rich quickly, they begin to feel as though they are falling behind, as though everyone else has discovered a secret that they somehow overlooked. That emotional pressure builds rapidly, and instead of analyzing the nature of the investment, the individual starts to chase what feels like an opportunity slipping through their fingers. In this environment, Bitcoin becomes less of an asset and more of a psychological trigger, activating desire rather than discipline. Another powerful trap is confirmation bias, where investors seek out information that supports what they already want to believe. Someone who wants Bitcoin to succeed will find endless articles, influencers, and commentators reinforcing that belief. They will ignore or dismiss opposing viewpoints, labeling them outdated, uninformed, or biased. This selective filtering creates an echo chamber where doubt is minimized and confidence is artificially inflated. In such environments, people stop questioning whether their assumptions are grounded in reality. They begin constructing narratives designed to comfort themselves rather than guide them. And those narratives can become so convincing that they blind investors to risks that would be obvious in any other context. The next psychological trap is the illusion of understanding. Bitcoin and other digital assets are wrapped in technical language, blockchains, hashing, decentralized systems, which makes many investors believe they understand more than they actually do. Being able to repeat terms is not the same as understanding the mechanics, just as being able to describe how a plane flies is not the same as being able to build one. But the human mind appreciates the feeling of familiarity, and when something appears complex, people assume it must also be valuable. Complexity becomes a kind of camouflage that shields weaknesses from scrutiny. Investors feel intelligent simply for participating, which creates a false sense of competence. And in markets, misplaced confidence is far more dangerous than ignorance. Then there is herd mentality, one of the strongest forces in any speculative market. Humans evolved to follow groups because survival often depended on sticking together. In financial markets, that instinct becomes a liability. When millions of people rush into an asset, each individual feels reassured that such a large crowd can't be wrong. But markets have proven time and again that crowds can be disastrously wrong. The tulip craze, the dot-com bubble, the housing market frenzy, all of these were driven by massive collective enthusiasm, and each ended in the same way. Herd mentality convinces people that risk decreases as more participants join, when in reality, the risk increases because the crowd is usually running toward excitement rather than value. The speed at which Bitcoin's price can soar is not evidence of stability. It is evidence of how deeply herd psychology has embedded itself in the market. Another trap emerges in the form of anchoring bias. Once someone sees Bitcoin at $60,000, any lower price begins to look like a discount. They tell themselves that if it has reached that level before, it will surely reach it again, and maybe even surpass it. But price history does not guarantee future performance, especially for an asset whose value is not tied to fundamentals. Anchoring creates the illusion that a previous high price is a benchmark of worth, when in truth it may have been the result of nothing more than excessive speculation. People become anchored to numbers rather than analysis, and they make decisions based on those anchors long after conditions have changed. Related to anchoring is the trap of sunk cost fallacy. Once investors put money into Bitcoin, they feel psychologically tied to the decision. Admitting a mistake feels painful, so they avoid it. Instead of reevaluating with a clear mind, they look for reasons to stay invested, convincing themselves that patience will be rewarded. They may double down, hoping a bigger bet will rescue the earlier one. This behavior is common in gambling, and the digital asset market often mirrors the emotional cycle of a casino more than that of a stable investment environment. People don't just hold because they believe, they hold because letting go feels like admitting defeat, and that emotional hurdle keeps them locked in place. The next trap is the thrill-seeking instinct. Many people are drawn to Bitcoin not because of its fundamentals, but because of the adrenaline associated with rapid price movement. Traditional investments grow slowly, steadily, predictably. Bitcoin, on the other hand, can surge dramatically in a matter of hours, creating a sensation that feels exciting, energizing, and immediately rewarding. For some, this thrill becomes addictive. They check prices constantly, chase volatility, and treat the market like a game. But markets driven by excitement rarely end well, because excitement is not a strategy. It is a distraction that leads people toward impulsive decisions and away from thoughtful evaluation. Another psychological influence worth noting is the power of community identity. Bitcoin investors often form tight-knit digital communities where cultural norms, slogans, and shared narratives reinforce collective belief. These groups celebrate holding the asset, criticize anyone who sells, and label skeptics as uninformed or fearful. When financial decisions become tied to identity, the danger increases significantly. People begin to defend the asset not because of evidence, but because of loyalty to the group. They hold not because the investment is sound, but because selling feels like betraying a community they've become part of. This emotional attachment amplifies risk, as individuals lose the ability to act independently of group influence. Another trap lies in the myth of the inevitable future. Many investors become convinced that Bitcoin will eventually dominate global finance, replacing traditional currencies and toppling entire industries. This belief isn't based on current adoption or measurable utility. It's based on a future imagined through optimism and reinforced by those who share the same vision. People stop evaluating the present and begin investing in a hypothetical future that may never exist. Markets are often dangerous when the narrative becomes more valuable than the asset itself, because narratives can persist long after the foundation weakens. The belief in inevitability blinds people to the possibility that the asset may not fulfill its promised destiny. Loss aversion plays another critical role. People fear losing money more strongly than they desire to gain it. When Bitcoin begins to drop, rather than cutting losses, many investors hope the decline will reverse, because realizing a loss feels too painful. This emotional response leads them to hold on to positions long past the point of rationality. They convince themselves that staying invested is the safer option, even when evidence suggests otherwise. In highly speculative markets, loss aversion can trap investors in a cycle of denial that magnifies losses instead of preventing them. Another subtle but powerful trap is the glamorization of success stories. People hear about early adopters who became millionaires or stories of individuals who invested small amounts and saw extraordinary returns. These stories become motivational symbols, circulating across media platforms, creating the illusion that anyone can replicate the same outcome. But the stories that never get told are the countless individuals who lost money, sold at the wrong time, or entered the market driven by excitement rather than understanding. The selective storytelling creates a distorted perception of probability, leading people to overestimate their chances of success and underestimate their chances of loss. Overconfidence bias then takes hold. Once someone has made one or two profitable trades, they begin to believe they have mastered the market. They assume they can outsmart volatility and time their entries and exits perfectly. But markets, especially those driven by sentiment, are unpredictable. Overconfidence causes investors to take on excessive risk, ignore warning signs, and hold beliefs that are stronger than the evidence supporting them. In speculative markets, overconfidence is often the final step before significant losses occur. All these psychological traps combine to create a powerful force that pulls investors toward assets that may not have the strength to survive long-term volatility. The mind becomes the greatest risk factor, convincing individuals to justify decisions that would seem unreasonable in any other financial context. Markets do not collapse because people suddenly become irrational. They collapse because people remain irrational for too long, caught in emotional cycles they fail to recognize. Bitcoin's rise has not just been a financial phenomenon, it has been a psychological one, shaped by the same forces that drove every major speculative bubble in history. And until investors learn to see these traps clearly, they remain vulnerable to the very risks they believe they have outsmarted. The difference between a real asset and a speculative illusion becomes clear the moment you examine what each one actually provides. Because value is never defined by price alone. It is defined by what you receive in exchange for your investment. A real asset offers something tangible, productive, or measurable. It might generate earnings, produce goods, deliver services, or hold intrinsic usefulness that does not vanish when market enthusiasm fades. A business continues to operate even when its stock price drops. A piece of land continues to exist, grow crops, or provide shelter regardless of the economic climate. Real assets have substance underneath them, something that remains when confidence shakes or speculation cools. And that substance is what prevents their value from collapsing entirely. Speculative illusions, on the other hand, depend almost entirely on perception. Their value rises not because they contribute something to the real economy, but because people believe they will continue rising. Bitcoin fits this category because it has no cash flow, no earnings, no dividends, and no operational activity. It does not create anything, and it does not promise future output. Its value is anchored solely to market sentiment, and sentiment can shift with breathtaking speed. When an asset's worth relies completely on the belief that someone else will pay more later, the danger becomes obvious. The moment the crowd hesitates, the illusion begins to weaken, and illusions rarely fade slowly. They burst because there is nothing structural beneath them to absorb the shock. Real assets survive panic because their value is tied to something independent of emotion. A productive company can endure because it still has customers, inventory, and revenue. A farm can survive because people still need to eat. Even gold, which skeptics often compare to Bitcoin, has industrial, medical, and technological uses that ensure its relevance. Bitcoin's relevance, however, is tied entirely to the promise of appreciation. If that promise disappears, what remains is a digital token with no inherent function outside of being traded. Without economic output supporting it, Bitcoin behaves more like a collectible than an investment. And collectibles throughout history have been some of the first things abandoned during financial downturns. Another key difference is how each reacts to regulatory or technological changes. A real business can adapt, innovate, or pivot when conditions shift. A speculative asset cannot adjust its purpose, cannot evolve its utility, and cannot generate new forms of value when under pressure. Bitcoin is locked in place by its own design. If sentiment weakens or if external forces undermine its appeal, it has no mechanism to compensate. A stable investment should be able to weather storms and adjust to new realities. A speculative illusion simply waits for the next emotional wave to lift it or the next shock to break it. Understanding this difference is critical because many investors confuse high price and rapid appreciation with genuine value. True value endures, speculative value evaporates, and when the asset provides nothing beyond the belief that someone else will want it later, it becomes a fragile creation, vulnerable to the same emotional currents that once lifted it so high.